So joining us now on set is Ron Insana, Contrast Capital Partners co-CEO. He's also a CNBC contributor, a familiar face for years at CNBC.
Decades even.
Yes, I didn't want to say that. I don't want to date you there. Also remotely here is Eric Freedman, Chief Investment Officer over at U.S. Bank Asset Management Group. Ron, Eric, thank you both for being here. Maybe we'll set the stage first on a macro level with you, Ron. This is a market, and we've had this debate among many different people on this network about whether or not the Fed is being enough proactive in terms of its approach, or is it still being reactive to what Kelly points out, rightfully so, is backward-looking data?
Yeah, I'm in Kelly's camp firmly. I mean, and she knows this. And what I just heard from Jeff about Larry Summers, which I missed this morning, and I didn't read Jason Furman's op-ed because I follow him on Twitter. They've been putting up, Phillips curve graphs on Twitter and talking about wage inflation and all these other things, and the Fed need to be more aggressive. You remember 4 weeks ago, Larry Summers said that the Fed should not commit to anything in the future, one way or the other.
2 U-turns in a row.
Talked about a Wile E. Coyote moment where the economy falls off a cliff. I don't get what's going on. I've got a piece coming out on Monday on CNBC.com talking about Fleetwood Mac and the Fed never going back again. I think part of what they're higher for longer is not wanting to go back to zero in as much as it's wanting to fight inflation. They're probably overdoing it on the inflation front. And we're starting to get hints from a lot of businesses that the consumer's slowing down while you've got real estate and manufacturing in recession. So, look, from a market perspective, very choppy, as we've said before,
I mean, Eric, these are all interesting points. And the reason why I guess in some ways it's so important is because when it comes to how market professionals are helping clients navigate these waters and their money, it comes down to whether or not there is a strategy you can even put into place for this. And I wonder, Eric, from your standpoint, what exactly is that? What do you tell your clients who come in saying, hey, you know what, I don't know what to do with myself right now?
Yeah, so Dom, it's a question we get quite a bit, and not to invoke another Fleetwood Mac song, perhaps the song we would use would be "Hold Me," which is a reflection on what we do with cash right now. You look at where we are with 6-month and 12-month cash. There's a real opportunity for clients to grab yield, and that doesn't happen very often. So really the way that we've been approaching it with clients is to say, look, probably have a little more of a defensive bias in terms of risk assets, skew the portfolio towards more cash flowing investments. We're smack in the middle of a very well-defined range for both the S&P between 3,800 and 4,200, and then the 10-year between 3.5 and 4.5. So, to Kelly's point from the earlier segment, you're going to likely see some more concerns about inversion. We think there's a great way to play that, which is to move cash off the sidelines and into more productive assets. And so that's been something we've been very consistent talking to clients about. And it's really helped drive some real returns in their portfolios.
What's interesting, Eric, and I just want to point this out to you. I think I've had more conversations with folks in the last, call it maybe month or so, about people talking about laddering certificates of deposit and laddering Treasury securities, 3 months, 6 month, 1 year, 2 year notes and bills, that sort of thing.